There is a ghost that haunts the stock market. It's a ghost that whispers a dangerous and seductive lie into the ear of every investor. From the novice opening their first trading account to the seasoned professional managing a nine-figure fund. The lie is this: to get rich, you must find the next big thing. You must discover the next Amazon before it's Amazon, the next Apple before it's Apple. You must be a visionary, a prophet of progress, capable of peering into the fog of the future and identifying the one brilliant company that will change the world and make you fabulously wealthy in the process. This lie is the engine of the entire financial media complex. It fuels the breathless headlines, the stocks to buy now articles, the frenetic energy of cable news, and the dreams of millions. It's a wonderful story, and for 99% of the people who believe it, it is the direct path to financial ruin. But there is another path, a quieter, dustier, less glamorous path that winds through the forgotten alleyways of Wall Street. It's a path littered with discarded, broken, and unloved things. It is the path of the scavenger, the pragmatist, the man who understands that a single, guaranteed dollar in his hand today is worth more than the promise of $100 in the uncertain future. This was the path walked by a young Warren Buffett in the 1950s and 60s, long before he became the Oracle of Omaha, long before he was a household name. It was the path that took him from a clever young man with a few $1,000s to a bona fide millionaire, laying the foundation for one of the greatest financial empires the world has ever known. He had a name for this strategy, a name that was as ugly and unpretentious as the companies it targeted. He called it cigar butt investing. The image is visceral, almost unpleasant. Imagine walking down the street and seeing a soggy, discarded cigar butt lying in the gutter. It's ugly. It's been used and thrown away by someone else. No one wants it. But you, with your peculiar vision, notice something others miss. There's still one good puff left in it. And that puff is free. You can bend down, pick it up, take that final free puff, and then toss it away and continue on your journey, slightly richer for the experience. That, in its raw essence, is the billion-dollar method we are about to dissect. It is the art of buying companies not for what they might one day become, but for what they are right now. A pile of assets so cheap that you are essentially getting a piece of the business for free. It's a strategy that requires no crystal ball, no prophetic vision of the future. It requires only arithmetic, patience, and the courage to be a contrarian, to walk into the parts of the market that everyone else is running away from. It is the art of turning Wall Street's trash into your personal treasure. This isn't about buying great companies. This is the great market mistake this principle prevents: the obsessive, singular focus on finding wonderful businesses. The world is full of mediocre, boring, and even failing businesses that are, for a brief period of time, priced so absurdly low that they represent a spectacular investment. By ignoring them, by only looking for the prom queen, the average investor misses out on a vast and fertile hunting ground for bargains. The financial transformation offered here is profound. You will learn to add a powerful, opportunistic tool to your arsenal, a tool that is most effective when fear is highest and prices are lowest. You will learn to divorce your emotions from your investment decisions and embrace a mechanical, unemotional way to find deep value. You will learn to see what others cannot, that in the stock market, just like in any market, the price you pay is the ultimate determinant of your return. And by learning to buy at prices that other people find unthinkable, you unlock the potential for returns they can only dream of. This is the story of the last puff, the foundation of the Warren Buffett strategy, and the first major key to unlocking genuine, durable financial freedom. The core philosophy of the cigar butt is a philosophy of pure, unadulterated value. It is a rebellion against speculation. In the grand cathedral of investing, where most people pray at the altar of future growth and technological disruption, the cigar butt investor is in the basement, sifting through the plumbing, looking for loose change. It's a philosophy born from the Great Depression, championed by Buffett's mentor, the legendary Benjamin Graham. Graham had lived through a market crash that wiped out fortunes built on hope and hype. He came to believe that the only true safety in investing came from a massive, quantifiable discount between the price you paid for an asset and its underlying intrinsic worth. The last puff is the ultimate expression of this idea. You're not buying a story. You're not buying a dream. You're buying cold, hard assets for less than they are worth, with the business itself, the operations, the brand, the future, thrown in for free. To truly understand this, we must travel back in time to the early 1960s, to a small, dusty town in Nebraska. Warren Buffett, then in his early 30s and running his private investment partnership, was not yet the oracle. He was a relentless scavenger, a financial detective poring over the dense black and white pages of Moody's industrial manuals, searching for treasure in the corporate graveyards of America. And one day he found a perfect cigar butt, the Dempster Mill Manufacturing Company. Dempster was a classic American relic. Located in Beatrice, Nebraska, it had been making windmills, pumps, and other agricultural equipment for nearly a century. But by the 1960s, it was a business in terminal decline. Rural electrification had made windmills obsolete. The company was losing money, its products were outdated, and Wall Street had left it for dead. It was the epitome of an ugly, unwanted stock. But Buffett, looking through his unique lens, saw something different. He wasn't looking at the failing business, he was looking at the balance sheet. He performed a simple, brutal calculation taught to him by Graham. He added up the company's current assets, the cash in the bank, the accounts receivable, money owed to the company, and the inventory of windmills and parts sitting in the warehouse. Then he subtracted all of the company's liabilities, every single dollar it owed to anyone. The number he was left with was the company's net current asset value. This figure represented the company's liquidation value. What would be left over if you shut the doors, sold off all the easily sellable assets, and paid off all the debts? Buffett discovered that Dempster Mill was trading on the stock market for a price that was substantially less than this liquidation value. At one point, he was able to buy shares for around $18, while he calculated the net current asset value to be over $72 per share. This was the cigar butt. The company was being given away for less than the value of its spare parts. Buffett began buying. And he didn't just buy a little, he bought a controlling interest. This was a key part of his early strategy. For him, a cigar butt wasn't just a passive investment, it was an opportunity for activism. He realized the current management was inept, content to oversee the slow, unprofitable decline of the business. So in 1961, after accumulating over 70% of the company's stock through his partnerships, he took control. He put himself on the board. He saw that the company's capital was being wasted on a failing enterprise. The logical, rational thing to do was to stop the bleeding, to liquidate the unproductive assets and return the cash to the shareholders, including himself. He installed a tough, disciplined operator named Harry Bottle to run the company. Bottle was a turnaround specialist. His mission was simple: cut costs, sell off unnecessary inventory, and generate cash. And he was ruthless. He slashed expenses, closed down unprofitable lines, and turned Dempster's collection of spare parts and rusty windmills into a mountain of cash. Within 2 years, the capital that had been trapped inside this failing business was freed. The stock price, which had languished for years, soared as the market began to recognize the vast gulf between its price and its underlying asset value. Buffett and his partners made a handsome profit, a quick and substantial return from a company everyone else had dismissed as junk. The Dempster Mill story is the perfect foundational anecdote because it contains all the elements of the cigar butt philosophy: a focus on assets over earnings, a deep discount to liquidation value, the courage to buy what is unloved, and the activist mindset to force the value to be unlocked. It was a victory of arithmetic over narrative, a testament to the power of finding that one last, free puff. What psychological forces allow a situation like Dempster Mill to even exist? Why would a market, supposedly efficient and rational, price a company for less than the cash and inventory it holds? The answer lies in the deep, often irrational wiring of the human brain. The first principle at play is what psychologists call the availability heuristic, combined with a powerful aversion to ugliness. Our brains are lazy. They prefer to make decisions based on information that is easily accessible and mentally fluent. Stories about exciting tech companies, revolutionary new products, and visionary CEOs are readily available. They are plastered across the news, discussed on social media, and promoted by Wall Street analysts. These stories are available and easy for our minds to process. A story about a failing windmill manufacturer in Nebraska. That information is buried deep in an obscure financial manual. It's unavailable, and our brains, by default, ignore it. Compounding this is our innate aversion to things that are perceived as ugly, broken, or in decline. This is a survival instinct. In the ancestral environment, things that were decaying or shunned by the tribe were often dangerous. We carry this instinct into the financial markets. A stock with a falling price chart, a business with shrinking sales, a company in a dying industry. These things trigger a primal feeling of disgust and fear. We want to be associated with winners, with growth, with the shiny and new. The cigar butt investor must consciously and deliberately override this deep-seated psychological programming. They must train themselves to see a falling stock price not as a warning sign but as a potential discount coupon. They must learn to associate the feeling of widespread pessimism not with danger, but with opportunity. Benjamin Graham famously said that the investor's chief problem, and even his worst enemy, is likely to be himself. He was talking directly about this battle against our own psychology. The market's emotional tide pulls powerfully toward popular, beautiful stocks and away from ugly, unpopular ones. By simply refusing to be pulled, by anchoring oneself to the rock of cold, hard numbers, the cigar butt investor gains an immediate and massive edge. So how do you translate this contrarian philosophy into a practical tool, a mental model you can apply to your own decision-making? The model can be called the liquidation lens. It's a way of looking at a business that strips away all the stories, all the projections, and all the noise, and sees it for what it truly is, a collection of assets and liabilities. Here is the step-by-step process to apply the liquidation lens. Step 1. Actively ignore the narrative. The first and most crucial step is to put on blinders to the company's story. It doesn't matter if they make a product you love or a product you've never heard of. It doesn't matter if the CEO is a charismatic genius or a bumbling fool. For this exercise, the story is irrelevant. It is noise designed to distract you from the numbers. Step 2. See assets, not operations. Open the company's latest financial report, specifically the balance sheet. Do not look at the income statement, which tells the story of recent profitability. Look at the balance sheet, which is a snapshot of what the company owns and what it owes. Train your eyes to see the line items not as components of a living, breathing business, but as items in a giant corporate garage sale. The cash and cash equivalents line is a stack of dollar bills. Accounts receivable is a pile of IOUs from customers. Inventory is a warehouse full of products. Property, plant, and equipment are the buildings and machines. You are mentally disassembling the company. Step 3. Apply a real-world discount. This is the crucial step of the pragmatist. A balance sheet is an accountant's opinion, not gospel. You must apply your own conservative discounts to the assets. Cash is cash, so you can value that at 100%. But accounts receivable? Some customers won't pay. A conservative approach might be to value receivables at 75 cents on the dollar. Inventory is even trickier. If a company is in trouble, its inventory might be obsolete or need to be sold at a steep discount. You might value it at 50 cents on the dollar, or even less if it's a fast-moving tech product. For property, plant, and equipment, the discount is even more severe. A highly specialized factory might be worth only 10 cents on the dollar in a liquidation. The key is to be brutally conservative, to calculate a value that you are almost certain could be realized in a worst-case fire sale scenario. Step 4. Compare the garage sale value to the price tag. After you've calculated your conservative discounted asset value, you subtract all liabilities, long-term debt, short-term debt, accounts payable, everything. The number you have left is your estimate, of the company's private, intrinsic liquidation value. Now, you compare that per-share value to the stock market price. If your liquidation value is $10 per share and the stock is trading at $5, you have found a potential cigar butt. You have found an investment where the downside is protected by a mountain of tangible assets, and the upside is the market eventually waking up to reality. This mental model forces you to be a ruthless realist, a core requirement for any successful deep value investing strategy. To truly appreciate the power of the liquidation lens, we must examine its opposite, the path walked by the 99% of investors. This is the path of the narrative trap. The narrative trap is the tendency to fall in love with a good story, often at the expense of any rational financial analysis. The story could be about a disruptive new technology, a cure for a major disease, or a visionary leader who is changing the world. These narratives are incredibly powerful because they appeal directly to our emotions, our hopes, our dreams, and our desire to be part of something big. The most catastrophic financial bubbles in history were fueled by the narrative trap. Think of the dot-com bubble of the late 1990s. The narrative was that the internet was changing everything, and that eyeballs and user growth were more important than old-fashioned metrics like revenue or profit. Investors, gripped by this story, poured trillions of dollars into companies that had no revenue, no profits, and in many cases, no viable business plan. A company like Pets.com became a household name, with a famous sock puppet mascot and a Super Bowl commercial. It raised $82 million in its initial public offering in February of 2000. Its narrative was compelling. It was going to revolutionize the pet supply industry by selling dog food online. The market loved the story, and for a brief moment, the company's stock soared. But the balance sheet told a different story. The company was spending fortunes on marketing and infrastructure, losing money on almost every sale it made. The underlying business economics were a disaster. The pile of assets was shrinking with every bag of kibble it shipped. Less than a year after its IPO, in November of 2000, Pets.com went bankrupt. The stock was worthless. The investors who bought the narrative lost everything. They weren't buying assets, they were buying a story. The cigar butt investor, applying the liquidation lens, would have taken one look at the balance sheet, seen the massive cash burn and lack of tangible value, and run in the opposite direction. The narrative trap promises exciting, world-changing returns, but often delivers permanent capital loss. The cigar butt philosophy promises one last, boring puff, but delivers a reliable, asset-backed profit. The direct financial connection of this core philosophy is the creation of a powerful, quantifiable gap between price and value. This is the wellspring from which all profits in this style of investing flow. When you buy $1 of assets for 50 cents, you are not speculating. You are arbitraging the market's pessimism. The financial impact manifests in two critical ways: downside protection and upside potential. The downside protection is the most important. By purchasing a company for less than its liquidation value, you are creating a floor for your investment. Even if the business operations continue to deteriorate and eventually fail completely, the sale of the underlying assets should, in theory, allow you to get your money back, and then some. This is what Benjamin Graham called the margin of safety. It is the single most important concept in value investing. It's the difference between investing and gambling. The gambler hopes the wheel lands on their number. An investor ensures the odds are so heavily stacked in their favor that even a string of bad luck is unlikely to cause a catastrophic loss. The upside potential comes from the market's eventual recognition of this value gap. There are typically three ways a cigar butt investment plays out. First, the market simply reprices the stock. Other investors eventually notice the absurd discount, start buying, and the stock price rises to more accurately reflect the asset value. Second, a corporate event unlocks the value. Another company might acquire the cigar butt for its cheap assets, immediately crystallizing the value for shareholders. Third, as we saw with Dempster Mill, an activist investor can take control and force the company to liquidate or distribute the excess capital. In all three scenarios, the return is generated not from brilliant future growth, but from the simple closing of the price-to-value gap. This directly impacts your portfolio growth by providing returns that are often uncorrelated with the broader market. While others are chasing high-flying tech stocks, you are quietly compounding your capital through these discrete, value-unlocking events. This is the foundational principle that transforms stock picking from a game of fortune-telling into a disciplined business of buying assets at a discount. It is the first and most vital step on the path to true financial freedom. The philosophy of the last puff provides the why, but the engine of the entire process is the cold, hard math. It's the arithmetic of safety that transforms this from a quaint idea into a repeatable, scalable strategy for beating the market. Warren Buffett's genius wasn't just in grasping the concept, it was in his relentless, almost obsessive application of the numbers. He understood that in the chaotic, emotion-fueled world of the stock market, the balance sheet was a sanctuary of logic. It was a place where, if you looked carefully enough, you could find certainty amidst the noise. This commitment to quantitative analysis, to letting the figures tell the story, is what separated him from the speculators and market timers of his day. It was his superpower, and it was a power he wielded with devastating effect. Perhaps no story illustrates Buffett's mastery of the arithmetic of safety better than his investment in the Sanborn Map Company. This is not just an anecdote, it is the masterclass in deep value investing, a perfect case study in how a determined analyst can uncover staggering value hidden in plain sight. In the late 1950s, Sanborn Map was another relic of a bygone era. For decades, it had enjoyed a monopoly on creating and updating incredibly detailed maps of cities and towns across the United States. These maps were indispensable for insurance companies, who used them to assess fire risk for individual buildings. The level of detail was astonishing. They showed building materials, the location of fire hydrants, the thickness of walls. It was a wonderful, profitable business. But by the 1950s, a new, more efficient method of risk assessment called carding was replacing the need for these elaborate, expensive maps. Sanborn's core business was in a slow, irreversible decline. Wall Street saw the writing on the wall and, as it so often does, sold the stock down to ridiculously low levels. Buffett, as was his habit, was sifting through his Moody's manuals when he came across Sanborn. He saw the declining map business, but he kept digging. He turned to the balance sheet, and what he found there made his heart race. For decades, Sanborn, being a profitable monopoly, had been taking its excess profits and investing them in a portfolio of stocks and bonds. This investment portfolio was managed separately from the dying map business, and over the years it had grown to an immense size. Buffett did the math. He meticulously analyzed the securities held in Sanborn's investment portfolio and calculated their market value. He discovered that the value of this portfolio alone was worth approximately $65 for every share of Sanborn Map stock outstanding. The stock market, however, focusing only on the decaying map business, was pricing Sanborn's shares at just $45. The arithmetic was breathtakingly simple. By buying a share of Sanborn for $45, an investor was effectively paying 70 cents on the dollar for a $65 portfolio of high-quality stocks and bonds, and getting the entire, albeit declining, map business for free. In fact, Buffett described it as getting the map business for dollars than free. He was being paid $20 per share to take it. This was a margin of safety of epic proportions. The downside was virtually non-existent. Even if the map business went to zero overnight, the underlying investment portfolio provided a massive cushion of value. Buffett recognized this as the opportunity of a lifetime. He began to aggressively buy the stock, eventually committing a staggering 35% of his partnership's assets to this single investment. He traveled to New York, visited Sanborn's offices, and met with the management. He found them to be decent people, but they were treating the investment portfolio like their own private trust fund, unwilling to unlock its value for the shareholders. So just as he had with Dempster Mill, Buffett became an activist. He started a proxy fight, rallying other shareholders to his cause, demanding that the company separate the investment portfolio from the map business and distribute its value to the owners of the company, the shareholders. The fight was long and arduous, but eventually the management acquiesced. They agreed to use the investment portfolio to buy back shares from any shareholder who wished to sell, at a price close to its fair value. Buffett and his partners tendered their shares, realizing a massive, quick 50% return on their investment. The Sanborn map story is the ultimate testament to the arithmetic of safety. It was an investment built not on hope, not on growth projections, but on the undeniable, mathematical reality of a company's balance sheet. It proved that sometimes the greatest opportunities in the market aren't found in what a company does, but in what it owns. The reason such a glaringly obvious bargain like Sanborn map could exist for so long comes down to two powerful psychological biases: ambiguity aversion and salience bias. Humans are fundamentally uncomfortable with uncertainty. Ambiguity aversion is our documented preference for known risks over unknown risks. The future of Sanborn's map business was ambiguous. How fast would it decline? Could it be turned around? These were difficult, messy questions with no clear answers. The value of its stock portfolio, on the other hand, was a known quantity. It was a list of blue-chip stocks with daily market prices. A rational investor would focus on the value of the portfolio, but the human brain does the opposite. It fixates on the ambiguous, uncertain part of the story, the dying business, and the anxiety this creates causes it to sell the stock, ignoring the mathematical certainty of the assets. The cigar butt investor thrives in this ambiguity. They actively seek out messy, uncertain situations because they know that's where mispricing occurs. They ignore the ambiguous narrative and focus solely on the unambiguous arithmetic. The second principle at play is salience bias. Our brains are disproportionately influenced by things that are prominent, vivid, and easily noticeable. A dramatic headline about a company's declining sales is salient. A high-profile CEO announcing a bold new vision is salient. A stock price that is soaring or crashing is salient. A quiet, boring line item on a balance sheet listing a portfolio of municipal bonds? That is the opposite of salient. It's hidden, it's boring, and it's complex. The story of Sanborn's decline was a salient narrative. The story of its hidden investment portfolio was a non-salient fact buried in a financial document. The market, driven by salience, reacted to the exciting, visible story. Buffett, by training his mind to ignore the salient and seek out the important, was able to see the reality that everyone else was missing. This is a crucial skill for any contrarian investor. You must learn to tune out the loud, shouting headlines and listen for the quiet whispers coming from the footnotes of a 10K report. The biggest profits are often found in the most boring places. This leads us to the practical, applied mental model for harnessing this arithmetic of safety, the net-net blueprint. This is the specific quantitative method pioneered by Benjamin Graham and used by Buffett to find these deep bargains. It's a mechanical process that allows you to systematically identify companies trading for less than their net current assets. Here's the step-by-step blueprint that any retail investor can use. Step 1. Go to the balance sheet. Find a company's quarterly or annual report, the 10Q or 10K, and navigate directly to the consolidated balance sheet. This is your primary document. Step 2. Identify current assets. This is a specific section on the balance sheet. It includes assets that are expected to be converted into cash within 1 year. The main components are cash and cash equivalents, short-term investments, accounts receivable, and inventory. Add these up to get total current assets. Step 3. Apply conservative discounts. This is where you move from accounting to realistic valuation. Do not take the numbers at face value. A good starting point is the classic Graham formula. Value cash at 100%, accounts receivable at 75%, and inventory at 50%. You must adjust these based on the specific industry. For a retailer with fashionable clothing, inventory might be worth much less than 50%. For a company selling basic industrial parts, it might be worth more. The goal is to arrive at a discounted, realistic value for the current assets. Step 4. Subtract total liabilities. This is the most conservative step. Unlike the assets, you do not discount the liabilities. You subtract 100% of them. This includes short-term debts, accounts payable, and all long-term debt. Graham's original, strictest formula was to subtract total liabilities from the discounted current assets. The number you are left with is the net working capital. Step 5. Calculate the per-share value. Take the net working capital figure you just calculated and divide it by the company's total number of shares outstanding. This gives you the net value per share. Step 6. Compare to the market price. The final step. Look up the current stock price. If the stock is trading at a significant discount to your calculated net value per share, for example, if it's trading at 2/3 of the value or less, you have officially identified a net, a true cigar butt investment, according to the strictest definition. This blueprint is a powerful tool because it is entirely unemotional. It's a simple, repeatable, mathematical process. It doesn't ask you what you think about the company's future. It only asks what its current assets are worth right now. By running this blueprint on a list of potential stocks, you can systematically uncover bargains that the narrative-driven market has completely overlooked. To understand the genius of the net blueprint, we need to look at its antithesis, the growth at any price mentality. This is the approach that dominates bull markets and captures the imagination of the 99%. It is the polar opposite of the arithmetic of safety. A growth at any price investor actively ignores the balance sheet. In their view, assets are relics of the old economy. What matters is the speed of revenue growth, the size of the total addressable market, and the visionary quality of the leadership. They are willing to pay astronomical prices, 100 times sales, 1,000 times earnings, if there are any, based on the belief that the company will grow into its valuation in the distant future. This is not investing. It is pure speculation on a future that is fundamentally unknowable. Consider the case of many high-tech story stocks in recent years. A company with a revolutionary new software platform might go public with massive fanfare. It has millions of users, but it is losing hundreds of millions of dollars a year. Its balance sheet shows a mountain of debt and rapidly dwindling cash. A net investor would see this as a 5-alarm fire. A growth at any price investor sees it as a visionary company, investing in its future. They buy the stock at a valuation that assumes not just success, but decades of flawless execution and global market dominance. The problem is that the future is never that certain. A new competitor emerges, a technological shift occurs, a recession hits. Suddenly, the narrative shatters. And because the stock price was untethered to any tangible asset value, there is no floor. The stock can fall 90, 95, even 99%, resulting in a permanent and catastrophic loss of capital. The growth at any price investor is making a single, high-stakes bet on one possible future. The cigar butt investor, anchored by the arithmetic of safety, is making a low-risk bet on the mathematical reality of the present. This fundamental difference in approach is a primary driver of long-term portfolio growth versus long-term portfolio destruction. The direct financial connection of the arithmetic of safety is the explicit quantification of your margin of safety. This concept, when properly understood, is the most powerful wealth preservation tool an investor can possess. It is not a vague feeling of comfort. It is a number. When you use the net blueprint and find a company with a liquidation value of $10 per share that is trading for $5, your margin of safety is $5 or 50%. This has a profound impact on your financial outcomes. First, it dramatically reduces the probability of a large loss. Even if you are wrong about the company's prospects, even if things get worse before they get better, you have a $5 buffer protecting your capital. The business could lose value, the inventory could be sold for less than you estimated, but the sheer size of your discount provides a cushion against error and misfortune. Preserving capital is the first rule of successful investing, and a large margin of safety is your best defense. Second, it creates a situation of asymmetric returns. This is a critical concept for achieving financial freedom. An asymmetric return profile means that your potential upside is significantly greater than your potential downside. With a 50% margin of safety, your downside is, in theory, limited. But your upside is not. If the market reprices the stock to its fair liquidation value, you have a 100% return. If a competitor acquires the company for a premium above its asset value, your return could be even higher. You are participating in an investment where the odds are mathematically skewed in your favor. Heads, you win big. Tails, you don't lose much. Over a lifetime of investing, consistently finding opportunities with this asymmetric profile is the surest way to build substantial wealth. The arithmetic of safety isn't just about finding cheap stocks. It's about structuring your investments in a way that the mathematical probabilities of success are overwhelmingly on your side. It is the engine that drives true, risk-adjusted outperformance and robust portfolio growth for the retail investor. Even with a firm grasp of the philosophy and a mastery of the arithmetic, there is a third formidable barrier to becoming a successful cigar butt investor: the psychology of ugliness. It is one thing to identify a bargain on a spreadsheet. It is another thing entirely to have the emotional fortitude to actually buy it. These stocks are cheap for a reason. They are often surrounded by a cloud of pessimism, bad news, and outright disdain. The companies are in struggling industries, they have negative headlines, and no one on television is recommending them. To buy a stock in this environment is to commit an act of social and emotional rebellion. It feels wrong, it feels uncomfortable, it feels lonely. And overcoming this feeling, learning to embrace the ugliness, is the mark of a true contrarian. Warren Buffett's early career is a study in this psychological mastery. Consider his investment in Western insurance securities. In the mid-1950s, property and casualty insurance was seen as a dull, boring, and intensely competitive industry. It was the absolute opposite of the glamorous, high-growth sectors that captured the public's imagination. Western insurance was a particularly obscure and unloved player in this already unfashionable space. It wasn't making headlines. It wasn't disrupting anything. It was just a small, conservatively managed insurance company doing its job, day in and day out. The market, obsessed with more exciting stories, completely ignored it. As a result, its stock traded at a comical valuation. Buffett, doing his usual detective work, discovered that Western insurance was trading at just over 1 times its annual earnings. Let that sink in. The market was valuing the entire company at a price equivalent to what it earned in a single year. Furthermore, it was trading at a massive discount to its book value, meaning its underlying assets were worth far more than its stock price. Buffett didn't care that insurance was boring. He didn't care that no one else was talking about Western insurance. He saw the numbers. He saw a predictable, though not spectacular, stream of earnings. He saw a pile of assets. And he saw a price that made no logical sense. The ugliness, the boredom, the obscurity. These were not deterrents to him. They were the very source of the opportunity. He knew that the only reason he was being offered this incredible price was because the company was so unloved. So he bought it. He loaded up on the shares for his partnership. And sure enough, over time, the market's neglect faded. The company continued to generate steady earnings, and eventually the stock price rose to more accurately reflect its intrinsic value, handing Buffett and his partners another handsome profit. The story of Western insurance is crucial because the company wasn't a Dempster mill on the verge of liquidation. It was a functioning, profitable, albeit boring business. It was ugly, not because it was broken, but because it was unfashionable. Buffett's ability to look past the fashion of the day and focus on the substance of the value is a lesson in the psychology of true contrarian investing. The psychological forces that made Western insurance so cheap are among the most powerful biases in behavioral finance: herd mentality and recency bias. Herd mentality, also known as social proof, is our deeply ingrained instinct to follow the crowd. For millennia, our survival depended on staying with the tribe. To be cast out was a death sentence. We are therefore exquisitely sensitive to the opinions and actions of others. When everyone around us is buying a certain type of stock, our brain tells us it must be safe. When everyone is selling and expressing fear about a stock, our brain screams, "Danger! Get out!" To buy a stock that everyone else hates is to go against this powerful instinct. It creates a feeling of cognitive dissonance, a deep psychological discomfort. You are, in effect, telling the entire tribe that they are wrong. This is emotionally taxing, which is why so few people can do it consistently. Compounding this is recency bias, our tendency to take recent events and project them indefinitely into the future. If a stock has been going down for the past year, our brain assumes it will continue to go down. If an industry has been in decline, we assume it will decline forever. The market had seen the insurance industry struggle, and it projected that struggle into the future, pricing Western insurance as if it would never have another good year. Buffett was able to override this bias. He understood that business is cyclical, industries fall in and out of favor. A period of poor results does not mean permanent failure. By taking a longer-term view and anchoring his decision in the company's current asset value rather than its recent performance, he was able to immunize himself against the short-sighted pessimism of the market. Beating the market is not about having a higher IQ, it's about having a more disciplined emotional temperament. It's a war fought not on a trading screen, but in the 6 inches between your ears. To win this internal war, you need a mental model that forces you to think differently. The most powerful one for this purpose is the inversion filter, a technique heavily promoted by Buffett's partner, the brilliant Charlie Munger. Munger's insight was that many complex problems are best solved by inverting them. Instead of asking how to achieve success, you ask what causes failure, and then you avoid those things. We can apply this directly to finding unpopular stocks. Instead of asking what makes a great investment, you apply the inversion filter and ask, what makes a stock popular and therefore likely overpriced? Let's build the filter. Step 1. List the attributes of a popular, expensive stock. It probably has a charismatic CEO who is frequently on TV. It's in a hot, sexy industry like artificial intelligence or electric vehicles. The financial media writes glowing articles about it. Its stock price has gone up a lot recently. Analysts have universal buy ratings on it. It's a major topic of conversation on social media forums. It has a great story about how it's changing the world. Step 2. Systematically search for the opposite. Now, you have a checklist for finding ugliness. You can use stock screeners and news searches to find companies with the inverse attributes. Look for a company with a boring, unknown CEO. Find a company in a dull, neglected industry like manufacturing, shipping, or basic materials. Look for a company that gets zero or only negative press coverage. Find a stock whose price has been declining for a long time. Look for a company with no analyst coverage or only sell ratings. Find a stock that no one is talking about. This inversion filter is a powerful tool because it short-circuits your natural desire to be part of the popular crowd. It forces you to look in the places that your instincts tell you to avoid. It systematically guides you toward the dark, dusty corners of the market, where the real bargains, the true cigar butts, are most likely to be found. It is an active, conscious process of leaning into the psychological discomfort that sends the other 99% of investors fleeing. The path of the 99%, the antithesis of the inversion filter, is the path of chasing hot stocks. This is herd mentality in its purest, most destructive form. The modern retail investor is bombarded with signals telling them what's hot. An algorithm on their trading app shows them top movers. A social media influencer posts about a, quote, 10-bagger opportunity. A cable news channel runs a segment on the future of tech. These signals are designed to trigger a powerful emotional response, the fear of missing out, or FOMO. This fear is a potent driver of irrational financial decisions. The investor sees a stock soaring and imagines all the profits they could have made if only they had bought earlier. They don't want to miss the rest of the ride, so they jump in, often with little to no research into the company's underlying value. This behavior typically leads to a predictable and painful outcome. The investor buys near the peak of excitement, after the stock has already had a massive run-up. They are the last person to the party. Then, inevitably, the story changes. The company misses earnings, a competitor emerges, or the market simply loses interest. The hot stock begins to cool. As the price falls, the investor's FOMO is replaced by a new emotion: panic. The same herd that told them to buy is now screaming to sell. They capitulate and sell near the bottom, locking in a substantial loss. This emotional rollercoaster of buying high out of greed and selling low out of fear is the single greatest destroyer of wealth for the average investor. It is the direct result of outsourcing your decision-making to the crowd. The contrarian, by embracing the psychology of ugliness, does the exact opposite. They buy when the crowd is panicking and selling, and they sell when the crowd finally gets excited and starts buying. They are a professional fear and greed arbitrager. The direct financial connection here is the radical reframing of a core financial concept: volatility. For most people, and indeed for much of academic finance, volatility is synonymous with risk. A stock price that swings wildly up and down is considered risky. A stable, steady stock price is considered safe. The cigar butt investor, the true contrarian, sees this relationship in precisely the opposite way. For them, volatility is not risk, it is opportunity. A sharp, sudden drop in a stock's price is not a reason to panic. It is a potential entry point. The very market psychology of fear that creates the volatility is what creates the bargain price. Think of it this way: a department store announces a one-day 50% off sale. Shoppers don't see this as a sign of risk. They don't think the store is going out of business. They see it as a wonderful opportunity to buy something they want at a great price. They rush point into times the store, not out of it. The stock market is the only place in the world where, when things go on sale, customers run out of the store screaming. The contrarian investor understands that a falling stock price is simply a sale tag being placed on a piece of a business. Their job is not to predict the short-term swings of the price, but to calmly assess the underlying value of the business. If the price falls well below that value, they buy. The greater the pessimism and the greater the volatility on the downside, the bigger the sale and the larger their potential margin of safety. This mindset shift is transformative. It turns what most people experience as a source of stomach-churning anxiety into a source of exciting financial opportunity. It allows you to directly monetize the market's irrationality, turning widespread fear into personal portfolio growth. This psychological fortitude is the unseen and often unappreciated key to unlocking the power of deep value investing. We have explored the philosophy, the math, and the psychology. Now we arrive at the most practical and crucial pillar: the hunt itself. How does an individual, a retail investor, actually apply these principles in today's complex, high-speed market? It requires a specific mindset, not of a passive investor, but of an active hunter, a financial scavenger methodically searching for opportunities. This is not about getting lucky or receiving a hot tip. It's about developing a systematic process, a repeatable routine for uncovering undervalued stocks. It is the transformation of theory into action, the blueprint for building a portfolio of bargains. The perfect illustration of this hunter's mindset can be found not in a single transaction, but in the collected works of Warren Buffett's early career, his famous partnership letters. From 1957 to 1969, Buffett wrote 2 letters a year to his limited partners, explaining his strategy, detailing his investments, and reporting his results. Reading these letters today is like finding the operational manual for a master craftsman. They reveal a mind that was not gambling, but was running a disciplined, research-intensive business. Buffett categorized his investments into 2 main buckets: generals and workouts. The generals were his classic cigar butts, undervalued stocks that were cheap based on a quantitative analysis, but where there was no specific catalyst to unlock the value. He would buy a basket of these, patiently waiting for the market to re-rate them. These were his Western insurance-type investments. The workouts were different. These were special situations, often related to mergers, liquidations, or spin-offs, where the return was dependent on a specific corporate event happening, not on the general mood of the market. His Sanborn map investment, which required activist intervention, was a classic workout. What the letters show is the sheer volume of work Buffett was doing. He was constantly reading, constantly analyzing, constantly searching. He wrote to his partners, "I just read and read and read. I probably read 5 to 6 hours a day." He was consuming corporate reports, industry journals, and financial newspapers, building a vast mental database of companies and industries. His approach was not to find one perfect idea, but to generate a constant flow of potential ideas and then subject them to rigorous quantitative analysis. The letters reveal a process. He would identify a potential bargain, conduct deep due diligence, establish a price at which it offered a sufficient margin of safety, and then, if the price was right, he would act decisively. This wasn't a hobby. It was a full-time, methodical hunt for value. This is the mindset the modern retail investor must adopt to succeed with this strategy. The reason this methodical hunting is so necessary is explained by another powerful cognitive bias, the availability heuristic. We discussed this earlier, but it's particularly relevant to the practical process of stock picking. The availability heuristic states that we tend to overestimate the importance of information that is easily available to us. The entire financial media ecosystem is built on this principle. The companies you hear about every day, the Apples, the Teslas, the Amazons, are at the top of your mind. When you think about investing in stocks, these are the names that are most readily available to your brain. The universe of tiny, boring, undervalued companies is, by definition, not readily available. You will never see a headline that says, "Obscure industrial parts manufacturer in Ohio continues to be statistically cheap." Therefore, to find cigar butts, you must actively fight the availability heuristic. You cannot be a passive consumer of financial information. You must become an active searcher. You have to intentionally go looking for the information that is not being pushed to you. This means turning off the cable news and opening a 10K report. It means ignoring the list of most popular stocks on your brokerage app and instead running a custom screen for companies with low price-to-book ratios. It requires a conscious effort to seek out the obscure and the neglected. The hunter's mindset is the practical antidote to the availability heuristic. The hunter knows that the prize trophies are not found grazing in the open field where everyone can see them. They are hidden deep in the undergrowth, and you have to be willing to go in and find them. This brings us to the modern blueprint for the hunt, a mental model we can call the digital scavenger's guide. Thanks to technology, the tools available to the retail investor today are vastly more powerful than the printed Moody's manuals of Buffett's era. Here is a step-by-step guide to conducting your own hunt for net and other deep-value stocks. Step 1. Build your digital toolkit. The most important tool is a good stock screener. There are many available, both free and paid. FinViz, Yahoo Finance, and the screener built into your own brokerage platform are great places to start. These tools allow you to scan the entire market of thousands of stocks for specific quantitative criteria in seconds. Step 2. Run the contrarian screen. This is where you tell your screener what to look for. A classic net screen would look for companies with a price-to-net current asset value (PNCAV) of less than 1.0, or even more stringently, less than 0.7. You can also screen for a price-to-book ratio of less than 0.5 and a market capitalization of under, say, $300 million. The small market cap filter is crucial, as this is the part of the market that large institutions ignore, creating the retail investor's edge. This screen will generate a list of names, most of which you have never heard of. This is a good sign. Step 3. The 10-minute triage. Your list might have dozens of companies. You need a quick way to weed out the obvious duds. For each company, do a quick check for major red flags. Is the company burning through cash at an alarming rate? A net with a high cash burn rate can see its asset value evaporate quickly. Does it have a huge amount of debt, particularly relative to its assets? Is there any sign of management fraud or SEC investigations? A quick news search can reveal these. The goal of the triage is not to find a winner, but to quickly eliminate the most likely losers. Step 4. The deep dive. For the companies that survive the triage, it's time to do the real work. Download and read at least the last 2 annual reports, 10 kilosecond. Focus on the balance sheet and the footnotes. Understand the nature of the assets. Is the inventory likely to be saleable? Are the receivables from reliable customers? Look for clues about management. Do they own a lot of stock themselves? That's a good sign. Are they taking huge salaries while the company struggles? That's a bad sign. Step 5. Diversify your bets. This is absolutely critical. Do not find one cigar butt and bet the farm on it. The strategy is probabilistic. Some of your finds will go to zero. Some will be fraudulent. Some will just languish for years. The key to success is to buy a basket of them, 15, 20, or even more. By diversifying, you allow the statistical edge of the strategy to work in your favor. The big winners will more than make up for the losers, delivering strong overall portfolio growth. The antithesis to this disciplined, probabilistic approach is a pair of common mistakes made by the 99% analysis paralysis and the single golden ticket fallacy. Analysis paralysis is the state of endlessly researching a company without ever making a decision. The investor gets bogged down in the details, trying to understand every nuance of the business and predict its future with perfect certainty. They read every report, listen to every conference call, and build complex financial models. But because the future is inherently uncertain, they can never get comfortable enough to actually pull the trigger and buy the stock. They are waiting for a level of certainty that simply doesn't exist. The cigar butt hunter avoids this by focusing on the quantitative. The decision is not, is this a good business, but is this business statistically cheap enough to offer a margin of safety? The single golden ticket fallacy is the opposite problem. This is the investor who, instead of diversifying, goes all in on 1 or 2 ideas they believe are can't-miss opportunities. This is often driven by overconfidence and a desire for the thrill of a concentrated bet. They might do deep research on one company and become convinced it's the next big thing, or they might just fall in love with a story. This is incredibly dangerous. A single unforeseen event, a product failure, a lawsuit, a change in regulation, can wipe out their entire investment. The hunter's mindset embraces the fact that they will be wrong. Often, their success comes not from being a perfect predictor, but from building a portfolio where the winners pay for the losers and then some. It is a game of probabilities, not prophecies, and this is a core principle of sound asset allocation. The direct financial connection of the hunter's mindset is the construction of a truly probabilistic portfolio. This is a subtle but profound shift in how you think about stock picking and its impact on your wealth. Most investors think in terms of individual stocks. Will this stock go up? The probabilistic investor thinks in terms of the portfolio. Does this collection of stocks, as a group, have a positive expected return? They understand that the outcome of any single cigar butt investment is uncertain. It's a coin flip, but it's a weighted coin flip. Because they are buying at such a deep discount to asset value, the odds are skewed. Perhaps there's a 60% chance it goes up and a 40% chance it goes down. A single flip is a gamble. But if you flip that weighted coin 100 times, you are almost certain to come out ahead. By building a diversified basket of 15 or 20 deep bargains, you are essentially making many of these weighted bets. This approach transforms your portfolio's return profile. It smooths out the volatility of individual stock movements and allows the underlying statistical advantage of the value investing strategy to manifest. This is how small, disciplined retail investors can consistently achieve market-beating returns over the long run. They are not smarter than the market. They are simply more disciplined and are playing a different game. They are not trying to predict the future of a single company. They are exploiting a recurring market inefficiency at a portfolio level. This systematic, hunter-like approach is the engine that translates the theory of deep value into tangible, life-changing portfolio growth and, ultimately, is a cornerstone of achieving long-term financial freedom. we have arrived at the final pillar, a consideration of evolution and relevance. The cigar butt strategy was the bedrock of Warren Buffett's early success, the engine that turned him into a millionaire many times over. Yet, the Warren Buffett of today, the chairman of the multi-hundred-billion-dollar Berkshire Hathaway, does not practice this style of investing. He has famously said he evolved, moving from buying fair companies at wonderful prices to buying wonderful companies at fair prices. Does this mean the cigar butt strategy is dead, a relic of a simpler time? The answer is a resounding no. In fact, the very reason Buffett had to abandon it is the reason it remains more potent than ever for the individual retail investor. Understanding this evolution is the final key to properly integrating this powerful tool into your own financial arsenal. The pivotal moment in this evolution, the anecdote that marks the turning point in Buffett's entire investment philosophy, was the purchase of See's Candies in 1972. By this time, Buffett's investment partnership had been dissolved, and he was running Berkshire Hathaway, a former textile mill that he was transforming into a diversified holding company. He was no longer managing a few $1 million. He was managing tens of millions, and the sums were growing rapidly. It was at this point that his partner, Charlie Munger, began to exert a profound influence on his thinking. Munger was a brilliant mind who understood the power of quality. He repeatedly pushed Buffett to move beyond his purely quantitative Graham and Doddsville approach. Munger's argument was simple. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. When See's Candies, a beloved West Coast chocolate maker, came up for sale, it presented the perfect test case. See's was not a cigar butt, not even close. It was a fantastic business with a powerful brand, loyal customers, and consistent growing profitability. It was being offered for sale for $25 million. Buffett's initial analysis, filtered through his old cigar butt lens, made him balk. The price was roughly 3 times the company's tangible book value. The old Buffett would have dismissed it out of hand as too expensive. But Munger persisted. He convinced Buffett to look beyond the balance sheet and appreciate the intangible assets, the brand, the customer loyalty, the pricing power that didn't show up in the accounting numbers. He argued that a great business like See's would compound its value over decades, generating ever-increasing streams of cash that could be reinvested elsewhere. Paying a fair, even seemingly high, price for that kind of quality was a far better long-term strategy than constantly having to find and flip cheap, low-quality cigar butts. Buffett relented. They bought See's Candies, and it became one of the most successful investments in history. Since 1972, See's has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all on an initial investment of $25 million. It became the prototype for the modern Berkshire investment, a high-quality, durable business with a strong competitive advantage. The reason for this shift was simple: scale. Buffett was now managing so much money that he couldn't deploy it in the tiny, illiquid stocks that made up the cigar butt universe. Buying a controlling stake in a $10 million company was a huge move for his early partnership. For the Berkshire of the 1970s and beyond, it wouldn't even move the needle. He was forced by his own success to hunt for elephants, not mice. The See's Candies story is the tale of Buffett's graduation, a necessary evolution driven by the relentless mathematics of scale. The psychological principle underpinning this evolution is the ability to overcome commitment and consistency bias. This is our tendency to stick with our past decisions and beliefs, even in the face of new evidence. Once we have publicly committed to a certain way of thinking, it is psychologically painful to change our minds. It feels like admitting we were wrong. Many investors fall into this trap. They read one book on value investing, or become a disciple of one particular strategy, and they cling to it dogmatically for the rest of their lives. They become a cigar butt guy, or a tech growth guy, and refuse to adapt as market conditions, or their own personal circumstances change. Buffett's true genius was not in creating the cigar butt strategy, but in his willingness to transcend it when it no longer served his primary goal. He was not committed to a method, he was committed to a result, compounding capital at the highest possible rate over the long term. When the size of his capital base made the cigar butt method inefficient, he was able to shed that skin and adopt a new, more appropriate strategy. He didn't see it as a repudiation of his past, but as a logical evolution. This mental flexibility is incredibly rare and is a hallmark of truly great executive decision-making. The lesson for the individual investor is profound. Do not become a dogmatist. Your investment strategy should be a collection of tools, not a single hammer that you use for every job. This leads to a practical mental model for the modern investor, the portfolio toolbox. Think of yourself not as a value investor or a growth investor, but as a master craftsman. A craftsman has a toolbox filled with different instruments, each designed for a specific task. You wouldn't use a sledgehammer to fix a watch, and you wouldn't use a tiny screwdriver to demolish a wall. So too in investing. The cigar butt screwdriver is a precision instrument. It is the perfect tool for specific situations. In the depths of a bear market or a recession, when fear is rampant and indiscriminate selling creates thousands of bargains, the cigar butt approach is king. It's also ideal for sifting through neglected, small-cap corners of the market that institutions can't touch. But in your toolbox, you also need a compounder hammer. This is the tool for buying wonderful businesses, the See's Candies of the world, with the intention of holding them for decades and letting the power of compounding do the heavy lifting. This might be the right tool for the majority of your capital over the long term. You might also have a special situations wrench for workouts and merger arbitrage. The key is to recognize that different strategies work best under different market conditions and for different portfolio goals. The sophisticated investor doesn't ask, is cigar butt investing good or bad? They ask, is now the right time, and is this the right part of my portfolio, to deploy the cigar butt strategy? This approach to asset allocation provides the flexibility to adapt and thrive in any market environment. The antithesis of the portfolio toolbox is the dangerous mindset of strategy dogma. This is the investor who becomes a true believer in a single, rigid doctrine. The dogmatic value investor, for example, might refuse to buy a great technology company because its price-to-book ratio is too high, missing out on a decade of compounding growth. They apply 1950s metrics to a 21st-century business and are left behind. Conversely, the dogmatic growth investor might pour all their money into exciting but unprofitable story stocks during a bull market, only to be completely wiped out when the tide turns and the market starts caring about balance sheets again. They use the same strategy in a bubble as they would in a crash, with disastrous results. Strategy dogma is the enemy of long-term success because the market is a dynamic, ever-changing system. Rigidity is fragility. The investor who can only do one thing is destined to fail when the environment no longer favors that one thing. The craftsman with a full toolbox, however, can always find the right instrument for the job at hand. And this brings us to the final, direct financial connection, the enduring power of asymmetric returns and the retail investor's structural edge. The very reason Buffett had to abandon cigar butt investing scale is what makes it a fertile hunting ground for you. Massive institutions, the multi-billion-dollar hedge funds, mutual funds, and private equity firms that dominate the market have a problem. They have too much money. They cannot invest in a $20 million market cap company. The position would be too small to matter to their performance, and if they tried to buy a meaningful stake, their own buying would drive the price up, destroying the bargain. They are forced, by their sheer size, to hunt for elephants in the most competitive, most analyzed part of the market, large-cap stocks. This creates a massive structural inefficiency in the small-cap and micro-cap space. This is your private hunting ground. You, as a retail investor managing your own portfolio, can invest a few $1,000s in a tiny, neglected company, and it can have a meaningful impact on your portfolio growth. If that $10 million company gets acquired for $20 million, it's a 100% return for you. For a $10 billion hedge fund, that entire $10 million profit is a 0.1% gain, a rounding error not even worth the paperwork. This is your edge. This is your asymmetric advantage. The world of cigar butts is an arena where the professionals are barred from entry, leaving the field wide open for the disciplined, methodical individual. This strategy is not a relic. It is a timeless principle of buying assets for less than they are worth, and its viability for the retail investor is arguably greater today than it was in Buffett's time, thanks to the structural dynamics of the modern market. It is a proven path for turning Wall Street's trash into your treasure, a powerful tool in your journey toward lasting financial freedom. You have made a significant investment of your time and focus, and for that, you have been rewarded with more than just a story. You have acquired a complete mental tool, a billionaire's method for viewing the market not as a popularity contest, but as a weighing machine. You've learned the philosophy of the last puff, the arithmetic of safety, and the psychology of ugliness. You now possess the blueprint for a contrarian strategy that Warren Buffett himself used to lay the foundation of his empire, a method of finding deep value where no one else dares to look. This is a powerful weapon in your financial arsenal. But it's crucial to understand that this is just one piece of a much larger puzzle. The architecture of a truly unbreakable financial mind is a network of interconnected mental models. What you've just mastered is the engine for acquisition, the cigar butt method for finding and buying undervalued assets at a steep discount. It's the strategy that took Buffett from clever to rich. But it is not the strategy that took him from rich to legendary. That required a completely different machine, an engine built not for quick opportunistic pops, but for relentless multi-decade compounding. It required a shift in thinking from assets to enterprises, from price to power. The video that is now appearing on your screen is not a random suggestion. It is the next piece of the map. It is the missing link that connects the strategy of acquisition to the strategy of empire building. It holds the blueprint for the second, more powerful engine, the compounding machine that allowed Buffett to buy wonderful companies and hold them forever. You have learned how to find the discarded puff of a cigar. The question now is, are you ready to learn how to own the entire cigar factory? The choice to click is more than just a choice to watch another video. It is a declaration. It is a commitment to continue your ascent, to complete your mental arsenal, and to transform yourself from someone who finds bargains into someone who builds dynasties. The next piece of the blueprint awaits,